Hi, I'm Button for freefincal, and in this video, let's consider how much gold would protect a person from a market crash. Every time the price of gold increases, people are always asking, should I have a little bit of gold in my portfolio? Well, how much should they have in gold? That will make a difference in the portfolio. That's what we will look at. I have made several videos about gold. I'll link them here in the I button. I've made it very clear that the uh, gold price in INR depends heavily on the forex rate, that is the USD INR exchange rate, and the volatility is very high in gold, and the volatility is higher than stocks. So it's basically a very poor risk reward combination. Gold is risky like stocks and rewarding like fixed income in the long term. And one big mistake that people do is they seem to be extremely confused about accumulating gold and investing in gold. When I say I am investing in gold, it means I am tracking the price of gold. I am not interested in taking physical delivery of gold. I am not going to buy jewels. I'm just going to track the price of gold. I'm tracking the price of gold for two reasons. I can be a trader. I can move in and out from an ETF to get gains, or I have a little bit of exposure. How much we'll see, a little bit of exposure in my portfolio, so that because of the correlation between equity and gold sometimes is negative. When equity goes down, gold goes up, and sometimes vice versa. So the risk in the portfolio goes down and the volatility of the portfolio goes down. That's when you invest in gold. When you want to accumulate gold, you can either buy physical gold, there's no problem there, or you can buy the sovereign, something like a sovereign gold bond, or you can buy in ETF and hold it until when you actually need physical gold. You then redeem the instrument and then buy the physical gold. There's no risk at all if in holding a sovereign gold bond or an ETF, if your ultimate aim is to buy gold. So that is accumulation. That is trying to accumulate gold for marriage and so on. So please don't confuse yourself between investing in gold and accumulating gold. They are completely different. In this post, I'm talking about investing in gold so that my equity fixed income portfolio falls less in case there is a huge market crash like 2008. That is what this post is about. I have shown risk-free ways to accumulate gold. I have also talked about how these price depends on the forex rate. Gold price depends on forex rate, and how investing in gold is riskier than stocks. And I've also answered this question whether I should have gold in my portfolio or not. My answer is no, and I will again repeat it because this is the time to do it. So let's do some. Let's have a look at some numbers. So this is January 11th, 2008. The Sensex was 20,827, and it fell by 60% to 8,326 on the 6th of March 2009. That's a separation of 420 days. Over 420 days, a little more than a year, it fell by massive 60%. People who think they must have a lot of equity in their portfolio will have to suffer this kind of a loss. Someone commented, will there again be a loss? Will there again be a crash like 2008? Oh, please don't tempt the devil. There can be a bigger crash than 2008. Everything is based on trust. Equity markets, capital markets is based on trust. People are investing, everybody is hoping that they will make money. One day when the trust goes away, it will cascade, everybody will pull out money, and they're all screwed. So never ever overestimate the returns, and never ever underestimate risk. In this 420 for 20-day period, gold increased from 1,235 to 1,707. That's a 38% increase in gold INR per gram price. So that's the reverse correlation. So whenever there's fear in the stock markets, gold price tends to increase because there's a lot of demand for gold. but that doesn't mean you go to bed with it. We'll have to, everything has to be done in moderation. So let's take a portfolio of value rupees 100, and 40% of this is in debt, and 60% is in equity. Let's say that is the value as on 11th January 2008. After this 420-day window, the value became 100 becomes 667. That's because the equity fell 60, from 60 it became almost 24, and we will assume a 7% fixed income return. So that's a daily return of about 0.02%. So during this 420 day period, rupees 40 became 43.24. So the 100 rupees became 67. That's an overall portfolio loss of 33% almost. So even though the portfolio in equity, the exposure is only 60%, the loss is more than half the loss of the actual fall in equity itself. The Sensex fell by 60%, and the loss is little more than 50% of that loss. So 50% of the 60%. So, yeah, that's 30%, little more than 30%. So that's the loss. That loss without gold in a 60-40 kind of portfolio. The loss is about 30%, 33%. The question is, can I add gold to this portfolio and reduce this loss by about 40%? That is, I must reduce this loss from 32% to about 19 or 20% almost. That is 40% lesser loss by adding gold. How much gold should I add in the, to this portfolio? And I have shown several examples today in today's post. I'll show that in a moment. So I found that for a portfolio with 20% gold, 30% fixed income, and 50% equity. After all, you can't reduce equity less than 50% for long-term goals. That's not practical because you can't beat inflation then, considering long-term gold returns are very poor. So you cannot go below 50% in equity, and this means you have to only play around with this ratio, and you must have as much as 20% gold and 30% debt. So 100 rupees will become 80 rupees. So that's a loss of about 20%. And you can see that that's when the loss, that is the 32% loss where there is no gold in the portfolio, that loss has become 40% less to 20%. So you need that much gold, and that much gold is high maintenance. You have to please recognize gold will be extremely volatile. You have to rebalance it. You have to pay tax on it like a debt instrument. There will be two. You have to pay tax on this like a debt instrument, either as per slab or capital gains with indexation at 20%. Again, the same thing will apply here. This will be taxed like a equity fund or like in the case of stocks. So you have to rebalance this from time to time. You may have to tactically rebalance if you want. Either way, you have to take care of taxes and loads. So it's high maintenance, and is it even necessary? See, for a 40% reduction in loss, you need 20% gold. If you want to reduce this loss even more, then you need to add more gold. I mean, how much gold will you keep adding? It's just not practical. I have shown you other such examples, so different other scenarios in this post. I don't want to read it all. You can read the article in the description box. So, so in my opinion, that's not worth it, because I would rather have a proper fixed corpus in my mind, have a stepwise reduction in equity. So people keep asking, how do I plan for a big market crash? Two ways: either you reduce equity in a stepwise manner, or you make sure you gradually push enough money in the corpus, in the fixed income corpus, so that you are ready for the market crash. Because in India, you have nice fixed deposits, you have nice small savings schemes, you have PPF. That's your safe haven, that's your hedge. Gold is not the hedge in India, as long as these exist, in my opinion. I would rather push there instead of marrying myself into this volatile asset class just to lower overall portfolio risk. See, I've told you this several times. I have this video on how to reduce investment risk where I've shown the stepwise reduction in equity. Also, I mentioned in my audits that yeah, I'm looking at the target corpus for my son's education. I'm pushing gradually more and more money into his fixed income. So he's only 10 years old, but if he wants to enter a UG degree now, I have the money to pay. So that way I keep building that up as time progresses. Therefore, I don't have to worry about market crashes. That is, in my opinion, more prudent, less expensive, and more tax efficient way of managing risk and outlier risk. That is, this 420-day window over which the equity fell by 60% is an outlier risk. It's not going to happen every day, but I can still manage that outlier risk by this method instead of using gold. Just because all these guys who do portfolio management, they're all financial analysts. They don't think like investors. We have to think like investors, because for the analyst it's only return, beta, alpha. We're not going to eat with those. We need money, and keeping the corpus in mind as a target is, in my opinion, the smartest, simplest way to reduce risk. There is absolutely no need for gold in this. So that's it. If you have any questions or comments on this, please leave them below. Thank you. Bye.